Physical. As you are aware, every weekend on this channel, I delve into American markets, cryptocurrencies, commodities, and especially precious metals through two distinct videos. Over time, while discussing precious metals, I have been consistently advocating for the inclusion of physical metals within the portfolio basket. I've periodically mentioned that these metals might become suitable for trading, but for some time now, they haven't been the best fit for trading. I'd like to emphasize once more that we are presently in a period where the importance of physical holdings is growing, making it one of those critical moments when screen trading should be avoided. In this video, I will assess this situation and more. Let's begin. A substantial breakout may be on the horizon, but there are also downward pressures at play. When we examine global trends since April, we see that China ranks first among buyers, followed by India, with Turkey securing the third spot on the list. This list highlights Eastern countries as buyers, while Western countries lean toward selling. The United States, naturally, continues to pursue a path of selling its holdings to suppress prices. However, a game-changing moment might be on the horizon as the status of the reserve currency, the US dollar, faces unprecedented threats. We are actively searching for that tipping point. If you believe this turning point is still distant, it might be best to refrain from investing. But if circumstances abruptly shift, and we find ourselves on the path to a significant reset, the value of your dollars could diminish. Amid these potential scenarios, as the world transitions to a more bipolar system, there will still be a reserve currency, but there's also the possibility of a dual reserve currency or a gold-backed instrument gaining prominence. Therefore, holding physical gold and silver as a form of insurance would be prudent. Instead of fixating on the declining and fluctuating prices of gold and silver, consider that gold's price has largely stayed within a certain range in terms of dollars. Even during the past month, when it experienced one of its steepest declines, the changes we've discussed typically range from 5 to 10%. The same applies to silver. A 10% movement is considered significant in both cases. 3 years ago, when American interest rates hovered around zero, gold was valued at $1,850 in September. Today, it has dipped, bringing us back to where we started, at $1,850. In the interim, it reached $2,075 before falling back into the $1,600s. In terms of ounces, we remain within a certain range. However, in terms of dollars, gold is effectively shifting from the west to the east. Despite the price remaining relatively stable, there's a much higher potential for an upward movement due to the reality of inflation. Countries are divesting their American bonds, fearing that the U.S. may default on its debt and disrupt the global financial system. As a result, they are turning to the oldest forms of currency, gold and silver. If you share this perspective, consider holding some gold and silver as a form of insurance. We are still in the process of understanding these dynamics. If you believe it might be too late to invest, remember that the value of the dollar could diminish further if conditions worsen and a significant reset occurs. As the world moves toward a bipolar structure, the concept of reserve currency remains, but there's also the potential for a dual reserve currency or a gold-backed instrument to gain prominence. In this context, your physical assets will always hold value, making your portfolio a form of insurance and security. In the context of long-term gold buyers, consider China in red, Russia in blue, Turkey in pink, and India in green. These countries have consistently increased their gold purchases over the last 2 decades, indicating a regular flow of gold from west to east. This data suggests that while trading conditions may vary, the trend of gold moving from west to east remains consistent. When comparing gold and silver pricing, the chart in the middle reflects typical gold prices that we are familiar with. However, if gold were traded outside of American trading hours, it could potentially reach over $20,000. Within the American session, the price would remain around $2 to $3. Similar considerations apply to silver. If traded outside American hours, it could reach $227. Contrary to that, within the American session, it would only be around 21 cents. To sum it up, while prices may be managed downwards during American trading hours, they tend to rise during Asian trading hours. So, if you're considering trading, especially outside American hours, this could be an advantageous strategy. However, if you have a medium-term investment perspective and anticipate a significant shift, you may want to consider buying and holding. It's essential to monitor these trends on the screen for suitable opportunities. In conclusion, While there's no need to panic, it's prudent to be prepared for potential changes in the market. As global dynamics evolve, gold and silver retain their significance as a hedge against inflation and economic uncertainties. If you share this perspective, holding some gold and silver can serve as a form of insurance. Now, let's move on to our charts and analyze the current levels. Please share your opinions in the comments. Gold price, it has come down quite a bit. It's at $200. The weekly average is at $1,772, and I don't think it will go there, but you never know. There's a lot of pressure for me. The trend following level is $1,900. As long as it stays below that, the pressure may continue a bit more. I also have a weekly lifeline at $1,923. I expect the pressure to continue unless it breaks above that. However, if there's a sudden turnaround, these levels are important for me from a closing perspective. But when I take a closer look at the chart, when I zoom in the short term, it's in the oversold zone. Especially last week's sales were a bit exaggerated. It came into the oversold zone. Interest rates have risen. Forget about this and that. I'm saying this repeatedly. When you look at it in the long term, there is no reverse correlation with interest rate increases. In that regard, if you look carefully, for many years, while the United States was on the gold standard, they taught the world that this money has a cost, and gold doesn't yield anything to you. So you've learned this, but things are changing. This time, the rise in interest rates is not the same. I've explained this in the past, especially with 2020, things have changed, but the lessons learned in the past are still valid. Many economist friends and trader friends of ours are trying to trade by looking at the 10-year bonds. It may work in the short term sometimes, but in the long term, the correlation there will be exactly the opposite. Eventually, it will come out that America's rising interest rate is negative, but there is a big reception and depression pricing experiment there. Are Friday's sales especially a big crash? Is there a crash happening before that? We'll see at the beginning of the week. But look, if the debt ceiling problem isn't resolved, and if there's a shutdown, America's rating will naturally decrease, and I remind you that in that context, gold and silver may rise. So, how far will the manipulation continue during the American sessions? They can try it forever, but at some point, we will reach the point where things explode. Let's see where the levels are. $1,900 is still important. It was $1,909. There's a 200-day average, and we're monitoring these, but will we get a response from the oversold condition in the short term? We'll see soon. There is no change in our long-term chart, but those levels have been updated. We've come to around 1850 now. As long as it doesn't break above those levels, there's no point in discussing long-term targets on this chart. But let the long-term goals stay in the background. But if $1,900 and $1,923 break on a weekly basis, we can reconsider the goals. Silver. Let's discuss the current levels for silver. You see, when it breaches $25.50, it will trigger a significant upward move in the big picture. However, at present, it's on a downward trend. So, where could it potentially go? Notably, there's a 200-week average at $22.03, and things can get quite unpredictable below that point. Consider this: if silver continues to decline, as I mentioned last week, I've been purchasing physical silver as it goes down. It's important to understand that commodities like silver won't plummet to $0 or drop to $10. Therefore, these declines actually create medium and long-term buying opportunities for physical silver, rather than for trading purposes. So, my plan is to increase my physical holdings if this pressure persists, and I'll promptly update you if there's a sudden reversal. This price range is intriguing. If it holds and experiences a sudden turnaround, I'll do my best to provide you with updates promptly. On the daily chart, my trend following level is set at 22.89. If there's a closing price above this level, it could signal a short-term buying opportunity. However, it's essential to acknowledge the prevalence of manipulation in the silver market, which makes these levels more relevant for short-term trading. Now, moving to the weekly chart, my trend following level stands at 23.22. A weekly closing price above this level may indicate the beginning of upward movements. However, in the grand scheme of things, it's crucial to remember that $25.50 is the critical level for the long term. If silver surpasses 23.20, it could be the first signal for significant upward potential. The big signal will come when it rises above $25.50. As of now, though, there's noticeable downward pressure. Therefore, I'm discussing these levels more from an investment perspective rather than for immediate trading purposes. Keep them in the background for now. Gold-silver ratio. Currently, the ratio stands at 82.20, with 78 being a significant level. What's noteworthy is that 82.20 experienced a sharp break on Friday, followed by an unusual move that pushed silver prices down. It's essential to understand that silver and gold have a unique relationship in the world of precious metals. Often referred to as the jewelry of silver, silver needs to decline for other precious metals to rise. In this context, during the American session on Friday, we once again witnessed the kind of manipulation that I've been discussing since the beginning of this broadcast. Wheat. The price of wheat has experienced an abnormal drop to levels we haven't seen in months, and in some cases, even in 3 years. It reached a range between $525 to $555. I had previously included some wheat in my medium-term portfolios, and they are still part of my holdings, albeit incurring losses. However, as long as there is no position risk or leverage involved, I don't see any major issue because wheat, like many other commodities, is currently under significant pressure. It's worth noting that Russia, the world's largest producer of various commodities, has been actively involved in the markets, buying everything from platinum to palladium, wheat to gold and silver. This global involvement has put pressure on a wide range of commodities, as they attempt to control prices. While they have managed to suppress some commodities, such as natural gas, which they push down from $10 to $2, and oil, which they are actively selling to the world, this strategy may eventually backfire on Russia. Since commodities represent tangible, real products, there is a limit to how much they can be suppressed using fictitious products. This situation highlights the complexity of the current geopolitical landscape. As long as the pressure on wheat continues, I won't be adding any new positions or taking any significant actions. However, a daily closing above $555 could present a trading opportunity, and I personally consider the current pressure on wheat to be somewhat artificial. I want to emphasize once again the importance of not trading with leverage in commodity markets, unless and until there are clear breakouts above established formations. Regarding my existing holdings in medium-term portfolios for wheat, it's essential to remember that wheat dropped to $470 at the end of 2020, but that decline proved to be temporary as prices later rose to $1,300. These current price levels may indeed represent an opportunity, but I'm carefully monitoring how far this suppression can go before considering a turnaround. Brent crude oil $92.50. It's essential to pay close attention to the current price of Brent crude oil, which is at $92.50. There's a lot of discussion about the possibility of it surpassing the $100 mark, but it's important to note that there is significant pressure accompanying every price movement, and this is because there's a looming risk of a major crash. The demand side of pricing reception has seen a substantial decline, and now America faces a crucial decision. It can either accept this situation, which may involve measures to curb inflation and bring it down, or it can choose to push itself and the world into a major depression. This is a critical juncture, and the outcome could lead to either a controlled adjustment or stagflation. As long as the price of Brent crude oil holds at $92.50, it appears that we are on track to potentially reach levels between $100 to $103. From this perspective, the movement of Brent crude oil is of utmost importance and warrants close monitoring. Natural gas is outperforming oil this week, and as you may recall, I've been considering natural gas to be a safer option. As we approached the $2 range, my confidence in it grew. This week, we've tested the $3 range once again, had a slight pullback, but ultimately closed above $2.84. My trend following level is set at $2.90 or higher. Take a look at the beautiful bottom formation in natural gas. It even challenged the trend line. Right now, it appears that natural gas is gaining momentum, and in the upcoming weeks, it might become our favored commodity. There's potential for it to surge beyond $3, and this time, it might not halt there, possibly moving even more swiftly towards $3.50 or $4. So, it's time to start keeping a close eye on natural gas on your screens. You should know that we can trade it through ETFs. One option is UNG with leverage, but we're primarily focusing on the very short term. Additionally, you can consider adding unleveraged natural gas to your portfolio. I recommend conducting some research on natural gas ETFs. You can choose to hold them, or for those who actively trade on screens, remember that monthly contracts for natural gas are also available. Just like with uranium, which we've emphasized before, many commodities can be influenced, but some, like uranium, seem to be slipping out of their control. Now, it appears that natural gas might be following a similar path. Uranium has slipped from our grasp. Consider the current state of affairs between Russia and America, where tensions are at an all-time high, with conflicts seemingly erupting everywhere. However, it's important to note that uranium, which serves as the raw material for nuclear energy, is still being sourced from Russia. This underscores a fundamental truth about the world. While leaders often appear to be in constant conflict, there are also hidden partnerships at play. In recent developments, Russia has ceased selling uranium to America, and a significant portion of America's uranium supply comes from countries like Kazakhstan and Russia. This increased tension could potentially drive uranium prices even higher. You are likely aware of my medium-term targets. We have ongoing targets set as high as $77.77. Is it possible that we'll see a swift move towards those levels? I personally trade uranium through the uranium ETF, which we've been tracking from around $49.53. As long as it remains above $46.82, I find it favorable for trend following. If tensions continue to escalate, uranium may find itself breaking free from other market pressures, which could be a compelling reason to watch closely. In different markets, even during bearish times, you can identify specific products that can enhance your portfolio. I encourage you to consider this approach. I continue to strive to shed light on your path during these challenging times. I wish you all a profitable and fantastic week.